Tom Lee, head of research and chief investment officer at Fundstrat Capital, recently appeared on CNBC's Closing Bell and made a bold claim. He believes investors are missing what's coming next for the market. In this interview, Tom explains why he thinks Wall Street misread the Federal Reserve's latest meeting, why stocks could still have room to run, and what major risks could create a dramatic shift in market conditions later this year. First, I'll play you the clip from CNBC. Then I'll break down exactly what Tom Lee said and give you my own reaction and analysis. After that, we'll take a look at 3 nuclear energy stocks that could be strong long-term investments as demand for power continues to grow. Let's hear what Tom Lee had to say.
Joins us now. It's good to have you on our program today. Tell our producers, investors overreacted to the Fed meeting. It seems to be the consensus, the growing consensus that was what happened yesterday. Why do you think that?
Hi, Scott. Kevin Warsh has a very different communication style, and he plans to kind of modernize how the Fed monitors data. So I think the markets took the removal of that forward guidance and even looking at those dot plots as a hawkish pivot. But I think instead, I think it's a Kevin Warsh that's saying, listen, I'm going to be using modern data, real-time alternative data to understand what's going on with inflation. And at this moment, we have no conviction. So to me, I think it's actually a very markets-friendly view. I think the homework now is for investors to understand that if data changes, those dots are going to move pretty quickly. So I think overall it's actually quite a dovish meeting.
So 7,500 is where we sit right now on the S&P. Been looking for a few different scenarios to play out in the market between now and the remainder of the year. If you think that yesterday was dovish and a lot of other people thought it was hawkish, and you came into yesterday thinking that we were going to have some moment where the market was going to have a correction of some magnitude, have you changed that view?
Scott, we still believe later this year there is going to be an abrupt change of market conditions, one that feels very much like a bear market. But we don't want to stand and call a top. I think conditions are still favorable for stocks. You know, the SpaceX IPO was very successful. And as you know, there's been a cadence of pretty good news coming out of that company. And it is a very small float company with only 90 billion of float. And I think Kevin Warsh, his view, this was actually kind of a market reaction to his first press conference. But I think that the real challenge is going to come later this year. So I think, yes, very much there is going to be a change in market tone, but I think it's too early for people to expect that to happen now.
But when you say there's going to be a, quote, abrupt change of market conditions, I mean, you can't make a statement like that without telling me why you think that. What's going to happen?
Well, I think that there are, let's say we can see with pretty good visibility 3 things happening. You know, one is that we know markets eventually test, especially if a Fed that's redoing the framework with 5 task forces. I think that's in 2026. The second is that the IPO of SpaceX, today there's very little float, but that's going to unlock later this year in phases, along with the IPO of Anthropic and OpenAI. And the third is that because of just the disruptions we experienced so far in the Straits of Hormuz, there is in the supply chain coming shortages. Those are actually the preconditions. I think the fourth catalyst is that speculative firepower runs out. That will happen when some things like margin debt, experience levels that are associated with short-term corrections, or it could be that you could see a lot of cash move out of the sidelines. But I don't have any sense that investors are that bullish yet. So to me, I don't think that fourth piece is in place yet.
What makes this interview especially interesting is that Tom Lee is not simply saying everything is bullish from here. In fact, he openly warns that an abrupt change in market conditions could arrive later this year. So on one hand, he sees supportive conditions for stocks today, but on the other hand, he believes investors need to be prepared for a significant shift down the road. Let's break down exactly what he means and whether his argument makes sense. The first thing Tom Lee focuses on is the market's reaction to the Federal Reserve meeting. Many investors looked at the Fed's updated projections and interpreted them as a sign that policymakers were becoming more aggressive in their fight against inflation. In other words, investors thought the Fed was becoming more hawkish. Tom Lee disagrees with that interpretation. His argument centers around Kevin Warsh and what he believes is a new communication style emerging at the Federal Reserve. According to Lee, the market saw the reduction in traditional forward guidance and changes in how the Fed discusses future policy and immediately assumed that meant tighter monetary policy. But Lee's view is that this is not necessarily about becoming more aggressive. Instead, he sees it as the Fed acknowledging that modern economic conditions require more modern data analysis. Rather than relying heavily on traditional forecasts and long-term projections, the Fed may be moving toward using more real-time information and alternative data sources to evaluate inflation and economic activity. If that is true, then what investors interpreted as uncertainty could actually be flexibility. That is a very important distinction. A hawkish Fed is one that actively wants tighter financial conditions. A flexible Fed is one that is willing to respond quickly as data changes. Tom Lee believes investors confuse the second scenario with the first. Personally, I think there is some logic to his argument. Markets often react to changes in communication before they fully understand what those changes mean. Investors become accustomed to a certain style of guidance, and when that style changes, uncertainty often gets interpreted as something negative. The reality is that a data-dependent Fed could become more supportive of markets if inflation continues to cool. Tom Lee even goes as far as calling the meeting relatively dovish. That is a bold statement considering the initial market reaction, but his reasoning is straightforward. If policymakers are admitting they do not have strong conviction right now and are willing to adjust quickly as new information arrives, then future rate decisions could become more favorable than investors currently expect. The next major topic was the stock market itself. The interviewer pointed out that the S&P 500 is already sitting around 7,500 and asked whether Tom Lee had changed his expectation for a market correction after seeing the Fed meeting. His answer was fascinating. He did not abandon the idea of a future correction. In fact, he doubled down on it. Tom Lee said he still expects an abrupt change in market conditions later this year, something that could feel very much like a bear market. However, he does not believe investors should expect that shift to happen right now. This is where his outlook becomes more nuanced. Many analysts tend to be either fully bullish or fully bearish. Tom Lee is essentially saying that conditions remain favorable in the near term, but investors should recognize that the environment may become significantly more challenging later. In my opinion, this is actually a more realistic way to look at markets. Bull markets rarely end simply because people predict they will end. They usually continue longer than expected, driven by liquidity, optimism, and momentum before eventually encountering a catalyst that changes investor psychology. Tom Lee appears to believe we are still in that favorable phase today. One of the reasons he cites is the success of the SpaceX IPO. He points out that the available public float remains relatively small, meaning demand can have an outsized impact on the stock price. He also notes that positive news surrounding the company continues to emerge. The broader implication is that major growth stories remain intact. Investors are still excited about transformative technologies and companies that represent the future. As long as that enthusiasm remains strong, it can continue supporting overall market sentiment. What I find interesting here is that SpaceX is not just a company story anymore. It has become a symbol of investor appetite for innovation. When investors are willing to aggressively chase opportunities tied to space, artificial intelligence, and disruptive technologies, it usually signals that risk appetite remains healthy. That does not mean there is no danger ahead, but it does suggest that fear has not fully taken over the market. The most important part of the interview came when the interviewer challenged Tom Lee directly. If you are going to predict an abrupt change in market conditions, what exactly is going to cause it? Tom Lee then outlined several potential catalysts. The first involves the Federal Reserve itself. He notes that the Fed is going through a significant framework review process involving multiple task forces. Whenever policymakers rethink how they approach monetary policy, there is potential for market uncertainty. Markets thrive on predictability. If investors become unsure about how the Fed will react to future economic developments, volatility can increase. The second catalyst involves supply entering the market through major IPOs. This is a point that many investors may overlook. Right now, newly public companies like SpaceX have relatively limited tradable shares. Over time, however, additional shares become available through lockup expirations and secondary offerings. Tom Lee believes that later this year, investors could see additional supply not only from SpaceX, but also from major artificial intelligence companies such as Anthropic and OpenAI. When these companies become more broadly available to investors, capital may start rotating toward those opportunities. Think about it this way: there is only so much investment capital available. If some of the most exciting AI companies in the world suddenly become investable, money has to come from somewhere. That could create pressure on other areas of the market. Personally, I think this is one of the most underrated risks he mentioned. Investors often focus on economic data while ignoring liquidity dynamics. Sometimes markets decline simply because capital gets redirected toward newer and more attractive opportunities. The third concern involves global supply chains. Tom Lee references disruptions in the Strait of Hormuz and warns that shortages could emerge as a result. This is a reminder that geopolitics still matters. Investors can become so focused on artificial intelligence and Federal Reserve policy that they forget how vulnerable the global economy remains to disruptions in energy transportation and trade routes. If shortages begin affecting businesses or consumers, inflation pressures could return unexpectedly. That would create a difficult environment for both policymakers and investors. Then Tom Lee brings up what may be the most classic warning sign of all: speculation. He argues that eventually speculative firepower runs out. Markets can rise on enthusiasm for a long time, but there comes a point where investors become fully invested, leverage increases, and margin debt reaches levels associated with corrections. When everyone who wants to buy has already bought, the market becomes vulnerable. Interestingly, Tom Lee says he does not believe we have reached that point yet. He specifically notes that he does not sense extreme bullishness among investors. That is another reason he remains constructive in the near term despite expecting challenges later. And honestly, I think this is one of the strongest points he makes in the entire interview. Major market tops are often accompanied by widespread euphoria. You see people believing stocks can only go up. You see excessive leverage. You see investors dismissing risks entirely. While there is certainly excitement surrounding AI and technology today, I am not convinced we have reached that level of market-wide euphoria yet. That does not mean a correction cannot happen. Corrections happen all the time, but it may suggest that the final stages of this bull market could still have more room to run before a larger reset occurs. So when you put all of Tom Lee's comments together, his message is actually quite balanced. He believes investors overreacted to the Fed meeting. He sees the current environment as more supportive for stocks than many people realize. He believes innovation, IPO activity, and investor appetite for growth continue to provide fuel for the market. At the same time, he is warning investors not to become complacent. Later this year, a combination of Federal Reserve changes, increased IPO supply, geopolitical disruptions, and excessive speculation could create the conditions for a meaningful shift in market sentiment. Whether you agree with him or not, it is a reminder that markets are rarely as simple as bullish or bearish. The strongest rallies often occur when risks are still building beneath the surface, and the biggest corrections often arrive when investors least expect them. Now let's dive in and talk about the 3 nuclear energy stocks that could potentially benefit from one of the biggest investment trends of the next 2 decades. Let's start with the first stock on the list. Constellation Energy, ticker symbol CEG, is not just another utility company. In many ways, it has become one of the most strategically important energy companies in America. When most investors think about artificial intelligence, they immediately focus on semiconductor companies, cloud computing providers, or software businesses. But there is another side to the AI story that many investors are overlooking. AI requires an enormous amount of electricity. Every chatbot query, every AI-generated image, every large language model training session, and every massive data center expansion project depends on a reliable source of power. The problem is that traditional renewable energy sources alone cannot solve this challenge. Solar power is intermittent. Wind power is intermittent. Data centers, however, need electricity 24 hours a day, 7 days a week. That is where nuclear energy enters the conversation. And when it comes to nuclear energy in the United States, few companies have a stronger position than Constellation Energy. Constellation operates the largest nuclear fleet in the country. That alone gives the company a tremendous competitive advantage. Building a nuclear power plant is incredibly difficult. Obtaining permits is difficult. Meeting regulatory requirements is difficult. Finding skilled workers is difficult. And constructing entirely new facilities often takes years and billions of dollars. In other words, this is not an industry where new competitors can simply appear overnight. The barriers to entry are massive. That means the companies that already own valuable nuclear assets are sitting on infrastructure that could become increasingly valuable as electricity demand continues to grow. What makes Constellation particularly interesting is that management recognized this opportunity before many investors did. Instead of operating like a traditional utility, the company has spent the last couple of years transforming itself into something much bigger. It is increasingly becoming a critical power supplier for some of the largest technology companies in the world. The best example of this transformation can be found in one of the most talked about energy deals in recent years. The story begins with 3 Mile Island. For decades, 3 Mile Island was one of the most recognizable names in nuclear energy. Many people associated it with the 1979 accident that changed public perception of nuclear power in America. Yet today, that same facility is becoming a symbol of nuclear energy's comeback. In 2024, Constellation signed a 20-year power purchase agreement with Microsoft. Under that agreement, the company plans to restart the facility, now renamed the Crane Clean Energy Center, and provide more than 800 megawatts of carbon-free electricity to support Microsoft's growing data center operations within the PJM region. Think about the significance of that for a moment. Microsoft is one of the largest technology companies on the planet. It has access to virtually unlimited financial resources. If Microsoft is willing to commit to a 20-year contract to secure nuclear power, that tells us something important. It suggests that major technology companies increasingly view nuclear energy as a necessity rather than an option. This deal effectively created a new blueprint for the industry. Technology companies need enormous amounts of reliable electricity. Nuclear operators have the ability to provide stable baseload power. Long-term contracts benefit both parties. The technology company secures its future energy needs. The nuclear operator secures decades of predictable revenue. That creates a powerful business model, and Constellation was one of the first companies to capitalize on it. What makes this opportunity even more exciting is that Microsoft may be just the beginning. Since then, Constellation has expanded its strategy and secured another major agreement. The company signed a 20-year power purchase agreement with Meta. Again, this highlights the same trend. Some of the largest buyers of electricity in the world are increasingly turning toward nuclear energy as a solution to their long-term power needs. For investors, this matters because these agreements provide visibility. Instead of relying entirely on fluctuating energy markets, Constellation can secure long-term cash flow streams from some of the strongest counterparties in the world. That reduces uncertainty and improves earnings visibility over time. Another major catalyst for Constellation involves the company's existing nuclear fleet. The company successfully extended operating licenses across its Illinois nuclear facilities through 2047 and beyond. This may sound like a technical detail, but it is actually very important. When you own valuable assets that generate electricity at scale, extending their useful life significantly increases their economic value. These facilities can continue generating revenue for decades without the need for entirely new construction projects. That enhances the company's long-term earning power, but Constellation did not stop there. The company recently completed its massive $26.6 billion acquisition of Calpine. This deal transformed Constellation into the largest power producer in the United States. Scale matters. The larger your generation portfolio, the more flexibility you have, the more customers you can serve, the more negotiating power you possess, and the greater your ability to capitalize on rising electricity demand. Many investors focus solely on the nuclear side of the story, but this acquisition adds another layer to the investment thesis. Constellation is building an energy platform capable of serving a wide variety of customers while maintaining a strong focus on clean energy generation. When you combine the nation's largest nuclear fleet with the scale advantages created by becoming the country's largest power producer, you begin to understand why many investors are paying close attention to this company. Now let's talk about the broader industry backdrop, because this is where the long-term opportunity becomes even more compelling. Electricity demand growth in the United States was relatively stagnant for many years. Utilities generally operated in a slow growth environment. That is changing. Artificial intelligence is changing it. Data centers are changing it. Electrification trends are changing it. The power grid is facing increasing demand from multiple directions simultaneously. As demand rises, reliable sources of electricity become more valuable. Not just any electricity, reliable electricity. That distinction is important. A data center cannot simply shut down because the wind stops blowing. AI infrastructure requires continuous power generation. Nuclear energy provides exactly that. It delivers carbon-free electricity around the clock. This unique combination of reliability and clean energy production places nuclear operators in an increasingly attractive position. Constellation's management appears to understand this better than most. Rather than waiting for demand growth to arrive, the company is actively positioning itself to benefit from it. The early approval of a federal regulatory waiver for the 3 Mile Island restart further strengthens this thesis. Regulatory progress arrived sooner than expected. That improves confidence that the facility could return online in 2027 as planned. If successful, the restart would represent a powerful demonstration that previously retired nuclear assets can once again become valuable contributors to America's energy infrastructure. That could potentially open the door for similar opportunities across the industry. When I look at Constellation Energy, I do not simply see a utility company, I see a business sitting at the intersection of multiple powerful trends: artificial intelligence, data center expansion, energy security, decarbonization, and growing electricity demand. Few companies have direct exposure to all of these themes simultaneously. Of course, no investment is risk-free. Nuclear energy remains heavily regulated. Large projects can experience delays. Political attitudes can change, energy markets can fluctuate. Those risks should never be ignored. But when evaluating long-term investments, I often ask a simple question: does the company own assets that will likely become more valuable over time? In Constellation's case, the answer appears compelling. The company controls critical infrastructure that would be extremely difficult and expensive to replicate. It has secured long-term agreements with major technology companies. It has extended the life of key assets. It has expanded its scale through acquisition. And it operates in an industry that appears increasingly important for the future economy. That combination explains why many investors view Constellation Energy as one of the most attractive nuclear energy investments available today. For those looking to build a portfolio focused on long-term trends rather than short-term market noise, Constellation Energy is certainly a company worth studying closely. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Let's move on to the second stock on the list, and this one gives investors exposure to a completely different part of the nuclear energy value chain. That company is Cameco, ticker symbol CCJ. If Constellation represents the electricity side of the nuclear renaissance, Cameco represents the foundation underneath it. Because no matter how many reactors are built, restarted, or expanded over the next 20 years, they all need one critical ingredient: uranium. Without uranium, nuclear power plants do not operate. Without uranium, governments cannot expand nuclear capacity. Without uranium, the growing demand for reliable carbon-free electricity cannot be met through nuclear energy. And Cameco happens to be one of the most important uranium companies in the world. This is what makes the investment case so interesting. Instead of betting on a single reactor project or a specific power plant, investors are gaining exposure to a company that sits much closer to the center of the entire nuclear ecosystem. Cameco is one of the world's largest uranium producers. The company controls more than 433 million pounds of proven and probable uranium reserves. That is an enormous resource base. When you think about long-term investing, one of the most valuable characteristics a company can possess is ownership of scarce assets. Scarcity matters. If demand increases significantly while supply remains constrained, the value of those assets can rise dramatically over time. And that is exactly what many analysts believe could happen within the uranium market over the coming decades. The reason is simple. Building new uranium supply is not easy. Mining projects require significant capital. Permitting can take years. Environmental reviews can slow development. And geopolitical concerns have increased the importance of securing reliable fuel supplies from trusted regions. Meanwhile, demand continues moving in the opposite direction. More countries are embracing nuclear energy. Existing reactors continue operating. Governments are extending reactor lifespans. And entirely new facilities are being planned around the world. When demand rises faster than supply, companies with large reserves often find themselves in a very favorable position. But uranium production is only part of the Cameco story, and this is where many investors may underestimate the company's true potential. The most interesting piece of the investment thesis may actually be Westinghouse Electric. Cameco owns a 49% stake in Westinghouse. That ownership transforms Cameco from a pure uranium company into something much larger. Because Westinghouse is one of the most important names in the global nuclear industry, the company built the world's first commercial pressurized water reactor. Today, it continues providing services to a significant portion of the global nuclear fleet. In other words, Westinghouse does not just participate in the nuclear industry, it helps shape it. When existing reactors need maintenance, upgrades, engineering support, or operational services, Westinghouse is often involved. That creates recurring revenue opportunities that extend well beyond uranium production. Even more importantly, Westinghouse is positioned at the center of future reactor construction. The company's AP1000 reactor design has become one of the most widely discussed nuclear technologies currently being deployed internationally. Countries seeking to expand nuclear generation are increasingly turning to this technology. Projects are already advancing in places such as Poland and Bulgaria. As more countries seek reliable, carbon-free electricity generation, demand for proven reactor designs could continue growing. This is where the investment case becomes particularly powerful. Many investors think of Cameco strictly as a commodity company, but a large portion of its future value creation may come from its connection to reactor technology, engineering expertise, and nuclear services. That makes the company far more diversified than many people realize. And diversification can be a major advantage in a rapidly evolving industry. Let's take a step back and think about what is happening globally. Energy security has become a major political priority. Governments want cleaner energy, they want reliable energy, and they want energy independence. Nuclear power checks many of those boxes. Unlike some renewable sources, nuclear power provides continuous electricity generation. Unlike fossil fuels, it produces very low carbon emissions. And unlike imported energy sources, domestic nuclear infrastructure can enhance energy security. As a result, countries around the world are re-examining nuclear energy as part of their long-term strategy. That creates opportunities across the entire supply chain, not just for reactor operators, not just for utilities, but also for uranium suppliers and technology providers. Cameco sits directly in both of those categories. The company benefits when uranium demand rises. The company benefits when new reactors are built. The company benefits when existing reactors require servicing. That creates multiple potential growth drivers working simultaneously. Another exciting development involves small modular reactors. For years, one criticism of nuclear power was that traditional plants required massive upfront investments and lengthy construction timelines. Small modular reactors aim to address those challenges. They are designed to be smaller, more flexible, and potentially easier to deploy. Westinghouse has already submitted regulatory plans and begun construction efforts related to its AP300 small modular reactor. This technology is designed for industrial facilities, remote communities, and even defense applications. If small modular reactors gain widespread adoption, the market opportunity could become enormous. Think about it. Traditional nuclear power plants are generally built for large-scale electricity generation. Small modular reactors could open entirely new markets: manufacturing facilities, remote mining operations, military installations, growing population centers, and regions that lack large-scale power infrastructure. The addressable market expands significantly. Now, there is no guarantee that small modular reactors become the dominant solution many people hope for. But if they do, companies positioned at the forefront of that technology could benefit tremendously. And Westinghouse is one of the names investors should pay close attention to. Perhaps the biggest validation of Westinghouse's future came in 2025. That year, Cameco and Brookfield signed a binding term sheet with the United States Department of Commerce designed to accelerate Westinghouse reactor deployments globally. The scale of the opportunity is remarkable. The aggregate investment value associated with this initiative is expected to reach at least $80 billion. Think about what that means. The United States government is actively supporting efforts to expand reactor deployment around the world. This is not merely private sector enthusiasm. Government support is now becoming part of the growth story. Whenever you see private capital, industrial demand, and government backing all moving in the same direction, it is worth paying attention. Those forces do not always align. When they do, major investment opportunities can emerge. What I find particularly attractive about Cameco is that investors are gaining exposure to several different layers of the nuclear industry through a single company. First, there is uranium production. Second, there is reactor servicing. Third, there is reactor construction. Fourth, there is small modular reactor development. And fifth, there is increasing government support for nuclear expansion globally. Very few companies offer that combination. Another aspect that appeals to long-term investors is that nuclear energy is not a short-term trend. This is not a theme that disappears next year. Building nuclear infrastructure takes decades. Operating nuclear facilities takes decades. Energy planning often occurs on multi-decade timelines. That means companies positioned correctly today could potentially benefit for many years to come. As investors, one of the most powerful advantages we can have is identifying long-duration opportunities before they become obvious to everyone else. The nuclear sector may still be in the early stages of that process. Artificial intelligence is increasing power demand. Governments are prioritizing energy security, utilities are extending reactor lifespans, and countries around the world continue exploring new nuclear projects. Those trends support the long-term investment case. Of course, Cameco is not without risk. Commodity prices can fluctuate. Mining operations face operational challenges, project timelines can change, and nuclear expansion may occur more slowly than expected. Investors should always keep those realities in mind. But when evaluating the overall picture, Cameco offers something that many companies cannot. It provides exposure to both the fuel powering the nuclear renaissance and the technology helping build its future. That combination could make it one of the most compelling long-term nuclear investments available today. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move on to the third and final stock on the list, Vistra, ticker symbol VST. This is perhaps the most overlooked company among the three stocks we're discussing today. When investors talk about nuclear energy, the conversation often revolves around uranium producers or large nuclear fleet operators. As a result, Vistra sometimes gets less attention than it deserves. But that may actually be part of the opportunity, because while investors focus on the more obvious nuclear stories, Vistra has quietly been building many of the same advantages that have made other nuclear energy companies so attractive, and it has been doing so with considerably less fanfare. To understand the investment case, you first have to understand what Vistra actually owns. The company operates a diversified fleet of energy assets that includes nuclear power plants, natural gas generation facilities, and energy storage infrastructure. That diversified portfolio gives the company flexibility that many competitors simply do not have. Energy markets are constantly evolving. Regulations change. Demand patterns change. Technology changes. Companies with multiple ways to generate and deliver electricity often have more options available to them than businesses that rely entirely on one source of energy. But make no mistake, the nuclear assets are becoming increasingly important. Just like Constellation, Vistra is benefiting from one of the most powerful trends emerging in the energy sector, the explosive growth of artificial intelligence infrastructure. Over the past few years, investors have become increasingly focused on the semiconductor companies powering AI. That makes sense. Those businesses have generated enormous returns. However, there is another layer of the AI story that remains underappreciated. Every AI model requires electricity. Every data center requires electricity. Every cloud computing platform requires electricity. And the amount of electricity required continues growing at an extraordinary pace. Many industry forecasts suggest that power demand from AI infrastructure could rise dramatically over the next decade. Some estimates indicate that data centers may become one of the largest sources of incremental electricity demand in modern history. If that happens, energy producers capable of delivering reliable power could become some of the biggest beneficiaries. This is where Vistra enters the picture. In January 2026, Vistra and Meta announced 20-year power purchase agreements supporting 3 of Vistra's nuclear plants located within the PJM region. That announcement may not have generated as many headlines as some other energy deals, but its significance should not be underestimated. Think about what Meta is doing. The company is investing heavily in artificial intelligence. It is investing heavily in data centers. It is investing heavily in computing infrastructure. And to support those investments, it needs reliable long-term power. Meta could have pursued many different options. Instead, it entered into long-duration agreements connected to nuclear generation. That decision speaks volumes about where the market is heading. Large technology companies are increasingly realizing that dependable electricity is becoming a strategic asset. They are no longer simply buying power on a short-term basis. They are actively securing future energy supplies years and even decades in advance. For companies like Vistra, that creates a very attractive environment. Long-term contracts provide revenue visibility, they support future investment planning, and they help reduce uncertainty surrounding future cash flows. Investors often underestimate how valuable that predictability can be. When a company knows that major customers are committed for decades, management can make long-term decisions with greater confidence. That can improve capital allocation and support sustainable growth over time. But Vistra's investment thesis goes beyond a single agreement. The company's broader strategy is particularly interesting. Unlike some competitors that have pursued large transformational acquisitions, Vistra has generally expanded its zero-carbon portfolio in a disciplined manner. That may not generate as much excitement in the short term, yet disciplined growth often creates significant shareholder value over the long run. One of the biggest risks investors face when evaluating energy companies is execution risk. Large acquisitions can create integration challenges, unexpected costs can emerge, operational problems can develop, and anticipated synergies do not always materialize. Vistra's approach has generally focused on steady execution rather than headline-grabbing transactions. That strategy may prove beneficial as the energy landscape continues evolving. Another aspect of the investment case involves energy storage. Many investors focus exclusively on power generation. However, energy storage is becoming increasingly important as electricity systems become more complex. The ability to store electricity and deploy it when needed creates additional flexibility. As energy demand patterns become more dynamic, storage assets may become increasingly valuable. Vistra's presence in this area provides another layer of optionality that investors should not ignore. Now let's talk about what may be the most important part of the Vistra story: pricing power. When investors think about great long-term businesses, pricing power is often one of the first characteristics they look for. Companies with strong pricing power can often maintain profitability even as costs rise. They can adapt more effectively to changing economic conditions, and they frequently generate attractive returns over extended periods. The question is whether energy producers can develop meaningful pricing power in the future. Vistra's investment thesis suggests they can. Specifically, the company is positioned around the idea that firm, dispatchable, carbon-free power may become one of the most valuable commodities in the economy. That phrase is extremely important. Firm power, dispatchable power, carbon-free power, not intermittent power, not occasional power. Reliable power available whenever customers need it. As AI infrastructure expands, the value of reliable electricity could increase substantially. Companies building billion-dollar data centers cannot afford interruptions. Cloud computing providers cannot afford interruptions. Mission-critical infrastructure cannot afford interruptions. As a result, owners of dependable electricity generation assets may find themselves in a stronger negotiating position over time. This is where Vistra's nuclear portfolio becomes particularly attractive. Nuclear facilities provide exactly the type of electricity many large customers increasingly want: reliable, stable, carbon-free, available around the clock. If demand for that type of power continues growing faster than supply, owners of those assets could benefit significantly. What makes this opportunity especially compelling is that the trend appears durable. Artificial intelligence is not likely to disappear next year. Data center construction is not likely to stop next year. Digital infrastructure spending is not likely to vanish next year. These are long-term trends that could continue shaping energy markets for many years, and Vistra appears positioned directly in the path of those trends. Another reason I find Vistra interesting is that it offers a somewhat different risk profile than the other companies discussed in this video. Constellation Energy offers dominant nuclear scale. Cameco offers exposure to uranium and reactor technology. Vistra offers diversified energy generation combined with growing nuclear relevance. That diversification may appeal to investors looking for exposure to the nuclear theme without relying entirely on one specific part of the value chain. As always, risks exist. Electricity markets remain competitive. Regulatory policies can change. Economic conditions can impact energy demand. Operational challenges can emerge. No investment is guaranteed to succeed. However, when evaluating long-term opportunities, it is often helpful to focus on the big picture, and the big picture here is straightforward. The world needs more electricity. Artificial intelligence requires enormous amounts of electricity. Reliable power generation is becoming increasingly valuable, and Vistra owns assets that help meet that demand. When I compare all three companies discussed in this video, what stands out most is that each one benefits from a different aspect of the same long-term trend. Constellation Energy benefits through operating one of the largest nuclear fleets in the country and securing long-term partnerships with major technology companies. Cameco benefits by supplying critical uranium resources and participating in reactor technology through its Westinghouse ownership stake. Vistra benefits through ownership of power generation assets that could become increasingly valuable as electricity demand accelerates. That is what makes the nuclear investment theme so fascinating. There are multiple ways to participate. Some investors may prefer the stability of power generation, others may prefer exposure to uranium production, and some may want a combination of both. Ultimately, the best choice depends on your individual investing goals, risk tolerance, and portfolio strategy. But one thing seems increasingly clear. The conversation around nuclear energy today looks very different from the conversation investors were having a decade ago. Growing electricity demand, AI expansion, energy security concerns, and decarbonization efforts are all helping bring nuclear energy back into focus. And companies positioned correctly could benefit from that shift for many years to come. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we wrap up, I want to hear from you. Which company do you think has the strongest long-term competitive advantage? Constellation Energy with its massive nuclear fleet, Cameco with its uranium reserves and Westinghouse stake, or Vistra with its growing portfolio of reliable power generation assets? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.